The purpose of this video is to help you understand what the business cycle is and what statistics such as GDP, unemployment rate, and CPI, meaning inflation, all mean, and how you would see those described visually in certain types of graphs. And then to help walk you through the answers to the fiscal and monetary policy homework so that you can do well on your quiz. This diagram is a visual representation of what we refer to as the business cycle. It's basically a visual view of the pattern that our economy follows over a long period of time. The word cycle means something repeats, a pattern that repeats. And business refers to, the entire economy, millions of people going to work and producing and getting paychecks and spending that money, and businesses producing things, thousands of businesses producing things that we want to buy. That's the economy. And this is the pattern that it follows over time. It's called the business cycle because the pattern repeats itself over and over. You are going to witness this exact pattern multiple times in your life. And this not only shows up on a test, but you will, like I said, witness this over and over and over again in life. If you look at the red line, the one that's kind of wavy and going up and down and up and down, that's the pattern. The ups are labeled expansions, and the downs are labeled recessions. And that's trying to tell you that our economy has these boom and bust periods, basically, where times where the economy is running well, businesses are hiring, businesses are producing, and then we don't have to get into the whys. You can take an actual econ course for that. But what happens in our economy is that inevitably these expansions kind of top out, and businesses start to lay off workers because they can't find customers for their products. Resources are scarce, so they get more expensive. And basically, at the peak, businesses decide independently, but it happens, to lots of businesses at the same time across the economy, and they start laying off workers. And that is a kind of a vicious cycle, because when you lay off a worker, then they don't have paychecks, they can't spend their money, and that hurts businesses and other workers and other businesses, and it sort of feeds on itself. In the recession, and the economy tends to take a dip. And then what happens after a while is enough workers have been laid off, they're willing to work for cheap. Businesses have gone out of business, and resources become plentiful again, and they become cheap. So then businesses decide to hire and start producing this stuff again. And then what happens is we kind of bottom out, and then we start expanding again, and the cycle just sort of starts all over again. That's the business cycle. What you have to know is basically, first of all, what is that red line actually measuring? Notice that the x-axis is labeled time, and the y-axis is labeled GDP. GDP is a statistic you have to know. Gross domestic product. Gross means total. Domestic means within the country. And product means just stuff that the economy produces. Those millions of workers and thousands of businesses produce stuff all the time, and it's given a dollar value over the course of a year, and that is our GDP. The United States has the highest GDP of any country in the world. Eventually China will catch us, but that's not a big deal. The point is, we're a very productive people, we're a very productive economy, and current GDP is somewhere in the neighborhood of $27 trillion worth of stuff every year. You may remember that the way to measure a country's economy is through a statistic called gross domestic product, total economic output of a country over the course of a year. This graph shows how U.S. gross domestic product has grown pretty consistently since the late 40s. And from when it was probably less than $1 trillion a year to current day, where it's 25, $26 trillion a year. This line consistently goes up, but occasionally does not go up very quickly, or in some points goes actually down. If you look at the 2008-2009 Great Recession period, GDP actually was negative there for a while. And of course, the pandemic-related recession of 2020, you see a big dip there too. On this chart, focus on the shaded areas. There's one in 2020, one in early 2008, 2009, one in the early 2000s, one in the early 1990s, a couple in the early 1980s, mid 70s, 1970-ish. You see the picture. Those indicate when the United States were officially in a recession, and GDP was either growing very slowly or contracting. This chart shows the business cycle a little better visually anyway, because this is not how just GDP tends to go up over time, but this chart measures how GDP changes from year to year. And whenever you see that blue line above zero, that means that the United States economy was growing. GDP was a positive percentage compared to the year before. Whenever you see the line dip below zero, that means the economy shrank compared to the year before. And I think if you look very closely, if you pause the video and look very closely, you'll see that pretty much every time there's a quote-unquote recession, as indicated by those shaded areas, you'll see a pretty pronounced dip in GDP as well. So this is a better view of the business cycle because it shows how GDP grows quickly sometimes, but not as quickly in other times, and actually is negative at certain other times. So maybe compared to the previous slide, this is a better visual representation of the business cycle that you learned about in your previous homework. This line graph shows the same kind of pattern over and over again. You see, again, the shaded areas that indicate each recession we've had in the last few decades. But the line graph going up and down measures, this time, unemployment. So it actually goes up and down in reverse comparison to the GDP chart. When GDP goes down on the previous chart, unemployment goes up, because that's pretty much the definition of a recession. Businesses are laying off workers and unemployment rate goes up. So if you could compare these side by side, or one on top of the other, you would see that when GDP goes down and we're in a recession, unemployment tends to reliably go up. Let's see. I'll just point out in this graph how dramatic the rise in unemployment was in 2020 compared to previous recessions. In all the previous recessions, it's a steep slope. Unemployment does go up quickly, but at least there's some rise over run, or at least it does take a little while for these statistics to go up, the unemployment rate to go up. But if you look at the 2020 recession, it's almost a straight line up, and that reflects the fact that basically millions and millions of people lost their job all in the space of a few weeks in the spring of 2020. This line graph shows a CPI, Consumer Price Index, which measures inflation. What you'll notice if you look closely, again, recessionary periods are shaded here, but if you look at the line really closely going up and down, inflation tends to precede recessions. So inflation occurs when the economy is running too hot, when the economy is running too well. And then government policies step in to cool off the economy, and sometimes triggers a period of recession. So look at the blue line closely, and you'll notice that inflation peaks right before a recession hits, because I guess probably the proper way to look at this is that when the government steps in to address inflation, it often causes enough of a downturn in the economy that we can actually define in the next few months or year or so as a recession. This line graph shows how the Federal Reserve raises and lowers interest rates in response to economic conditions. Basically, what you want to look here for is when there's a recession, the Federal Reserve takes measures to lower interest rates in general as much as possible. This graph in particular is describing the ups and downs of the federal funds rate, which you don't have to know that specifically. Just understand that's like the lowest possible interest rate that anybody can pay for money. That's for banks lending money to each other. And the Federal Reserve affects that through open market operations. Remember from our fiscal and monetary policy lesson, when the Federal Reserve buys government bonds, that puts money into the economy, that raises the money supply, and that causes money to be cheaper, and interest rates go down. When the Federal Reserve sells government bonds, that takes money out of the economy, that causes the money supply to go down, and that makes interest rates go up. That means money is harder to get, more expensive to borrow, and that tends to cool off the economy. Here you see the federal funds rate going up and down. The most interesting part of this graph to you guys would be maybe look at 2008, 2009. When that recession hit, the Federal Reserve lowered its basic interest rate, called the federal funds rate, to practically zero, and it stayed that way for several years, making money very cheap for a long time, and that did have the effect of making money so relatively easy to get your hands on through borrowing. And consumers and businesses did respond, and the economy did get stimulated and take off. Fortunately, the 2020 pandemic, after Federal Reserve had raised interest rates as the economy got back to normal, the Federal Reserve lowered interest rates back to zero as a result of the pandemic recession. And now, because of our inflation that we're experiencing now is rising, is decided to raise interest rates again, and is doing so at a pretty fast pace. You can see that at the end of the graph. The rest of this video is showing you the answers to the fiscal policy and monetary policy homework that you received earlier. Hopefully your answers pretty much line up with what I was hoping you would find. Please fill in and correct anything that you have that's different from what I have. That'll be a good start on understanding fiscal and monetary policy. Basically, those ups and downs come with problems. Economic peaks usually generate inflation. Economic recession generally generates high unemployment, and we expect our government to do something about it. Our government does not control the economy, but it can influence the economy, and that's what fiscal and monetary policy are all about. And you have to kind of know the ins and outs of which policy works for what purpose and how they're used. So please, again, take a good look at the answers that I was hoping you would find. And please ask any questions in class, because this is complicated. A lot of adults can't understand this stuff, and I'm asking you to figure it out basically on your own at this point. So please save up any questions you might have for class so I can clarify whatever isn't clear. So yeah, take a look at the answers to that homework, and then do your best on the quiz if there is one, and I think in your case there is. Have a nice evening. Bye-bye.